Hey guys, in this video I'm going to be doing a analysis of a bear call spread. And what that is, if you're bearish on an index or a stock, it's a way to play it if you have a bearish view so that you make some money if the index or the stock is to decline in value. So, the Dow today is of January 27th. The Dow was down about 453 points, closed around 28,536. And, there's been fears of the coronavirus and how that's going to impact the economy in China and the US and things like that. So there's some uncertainty there in the markets. The investors are fearing that there's a potential pandemic. There's been a couple cases, about 5 cases reported in the U.S. and then many other countries as well. So just a way to, just an idea, just a thought to maybe how to play this. Again, I only recommend these for people that have a thorough understanding. It's kind of an advanced option strategy, but this is called a bear call spread. So if you are, bearish and have a kind of maybe a negative view of where the Dow and stocks are headed over the next month or two, this may be a way to play it. So this one, if you can see there, this would be doing the bear call spread. You'd be selling 2 of the $300 calls and buying 2 of the March 31st 305 calls for a net credit of 51 cents. And so on this one, if you do 2 of those, then based after commissions, you'd probably be looking around, depending on what broker you use. I'm going to assume for this example this is before commissions, so you're estimated you'd get a net credit of about $100 in this case. Your max loss would be about $900. You can see there in the max loss. And again, I only recommend this for sophisticated options traders. Never put any more than, say, 1% into any one trade of your options trading portfolio. So in this example, you're looking, maybe at a total, maybe a 10-11% return on a trade. And again, with these, I always recommend closing the position once you've made about half of your total expected gain. So I'm going to kind of walk you through this. So in this example, I'm going to assume that you'd be closing the trade, if today's January 27th, you'd be closing the trade around February 21st. Based on implied volatility levels of the call options in the Dow Jones Industrial Average, they're about 11 right now. So, it's expected, the expected profit and loss if you were to close the trade on February 21st would be about $50. So it'd be roughly about half of your upfront credit that you earned when you sold the call spread. And then again in this example, so we'd be looking at, if our total risk adjusted capital is about $900 in this example, say, you'd be targeting about a 5 to 6% return on this trade in about 45 days. We can see here in the bottom part of the chart the expected probability of success on this trade is about 95%, 96%. If you close the trade around, February 21st, call it. And again, the reason you always want to make sure that you're minimizing risk and properly allocating capital is because, there's a high probability of success with a trade like this, just because the Dow, in order for this to lose money on this trade, the Dow would have to, your break even, the Dow would have to be above 30,000, over the next month. So, if you think that it could happen, right? So there is a possibility, that you could, lose money. It's small, small probability, again, probably 4 or 5%, but you always want to make sure that you're protecting your capital just in case, the market rallies, up over 30,000 over the next month or two. So this is just a trade. It's a trade idea, and in this example, there's about a 96% chance of success on the trade, roughly. But there is about a 3-4% chance of losing money on the trade. And again, I think that always properly manage your risk. Just an idea for you. And thank you for watching the video. If you have any questions, please feel free to leave it in the comments section below. Thank you for watching.